Forget the cinematic myth we think we know. What we're actually looking at is Jordan Belfort, the real wolf of Wall Street, who quietly orchestrated one of history's most audacious pump-and-dump schemes, leaving a trail of shattered lives and regulatory reforms. Before the high-rises and the yachts, a young Belfort, fresh out of American University, tried his hand at a door-to-door meat and seafood business back in Long Island. It surprisingly collapsed, leaving him bankrupt by his mid-20s, almost a strange preview of his later, much larger failures. His first real shot at finance came at L.F. Rothschild as a trainee stockbroker in 1987. But just months later, Black Monday hit, the firm folded and Belfort was out, though not before getting a quick, sobering look at the system's vulnerabilities. Belfort then found his place at a small penny stock brokerage, selling low-value, high-commission shares. Here, he really honed his aggressive sales tactics, seeing the immense profit margins available in manipulating those obscure equities. Now, in 1989, he teamed up with Danny Porrush to start Stratton Oakmont, initially running it out of what was once an auto repair shop. The firm specifically targeted unsophisticated investors, promising them massive returns through relentless, high-pressure boiler room sales tactics. So here's the core fraud. Stratton Oakmont would quietly acquire big blocks of cheap, often worthless pink sheet stocks. These were typically companies with almost no public information or trading volume, which made them incredibly easy to manipulate. Next, Belfort's brokers aggressively pumped these stocks to their clients, inflating the price with completely fabricated hype. Once the stock reached its artificial peak, Stratton Oakmont and Belfort would quickly dump their shares, leaving unsuspecting investors with holdings that were suddenly worth almost nothing. Belfort actually developed a rather notorious sales methodology, his straight-line system, a psychological blueprint for high-pressure persuasion. This system trained brokers to quickly build rapport, identify perceived needs, and then close deals, no matter the stock's true value. Stratton Oakmont, for a time, became synonymous with over-the-top debauchery, all fueled by those illicit profits. From daily lavish parties to drug-fueled orgies, the office culture was specifically designed to motivate aggressive, completely unethical sales through extreme indulgence. Belfort famously crashed his 170-foot yacht, the Nadine named after his second wife, right in the Mediterranean. High on quaaludes, he insisted on sailing straight into a storm, which led to its sinking and a dramatic helicopter rescue by Italian special forces. The fraud didn't just stay with penny stocks. It really escalated into initial public offerings. Stratton Oakmont would underwrite IPOs, hold onto big portions of the shares, and then artificially inflate their prices, perhaps most notably with Steve Madden Limited. The SEC and NAST, now FINRA, started their investigations way back in 1992 after getting a deluge of complaints. Stratton Oakmont faced fines and sanctions amounting to millions, yet the criminal enterprise somehow kept going for years. To keep his millions hidden, Belfort set up a really intricate international money laundering scheme. This involved Swiss bank accounts and European associates like Jean-Jacques Handali, funneling funds through shell corporations to avoid detection. He even pulled family members into it. His wife's British aunt, Patricia Dubois, was used to ferry cash, often hidden in her clothing, into Switzerland. This was a deliberate move to get around international currency reporting laws. Federal prosecutors and the FBI, building their case for years, finally kicked off Operation Red Herring to bring down Stratton Oakmont. The sheer scale of the fraud and its international reach were pretty unprecedented for the OTC markets at the time. In 1998, Belfort was indicted on several counts of securities fraud and money laundering. He was facing a maximum of 25 years in prison, marking the official end of his wolf reign and the dramatic collapse of his empire. To get a much lighter sentence, Belfort made a plea bargain and worked extensively with the government. He gave crucial testimony against many of his former colleagues, including Danny Porrush, laying bare the inner workings of his criminal enterprise. Sentenced to 4 years, Belfort ultimately served just 22 months at Taft Correctional Institution. It was there, surprisingly, that he started writing his memoir, The Wolf of Wall Street, encouraged by his unlikely cellmate, comedian Tommy Chong. As part of his plea, Belfort was told to pay back around $110, $4 million in restitution to over 1,500 victims. This monumental sum remains a contentious point in his post-prison life, with ongoing legal disputes constantly popping up. After his release, Belfort essentially reinvented himself as a motivational speaker and author. His straight-line system surprisingly resurfaced as a legal sales training methodology, ironically drawing on those very manipulative tactics from his past. The huge success of his memoirs eventually led to the 2013 Martin Scorsese film, starring Leonardo DiCaprio. Belfort reportedly made over $1 million from the book and film rights, which sparked a lot of public debate over his financial recovery. Despite his new earnings, critics argued Belfort was glacially slow in meeting his restitution obligations. By 2013, he had only paid back a tiny fraction of the total, which pushed federal prosecutors to really intensify collection efforts against him. As of recent reports, Belfort still owes tens of millions. The government has aggressively gone after his assets, including a percentage of his speaking fees and book royalties, though payments have been inconsistent and heavily scrutinized. Belfort published a second memoir, Catching the Wolf of Wall Street, where he detailed his post-fraud life, his battles with addiction, and his rehabilitation. This further capitalized on his infamous past, carefully building a continued public persona. Today, Belfort commands significant fees for his global speaking engagements, now teaching ethical sales strategies to corporations worldwide. It's a stark and often criticized contrast to his original fraudulent origins. His speaking tours have taken him across dozens of countries, sharing his story and sales techniques. He's effectively transformed his notoriety into a lucrative global brand, showing us the true power of narrative control. So, his continued success sparks an interesting ethical dilemma for us. Does he genuinely regret his past, or is his redemption just another calculated performance, capitalizing on his criminal fame without fully atoning for his victims? Despite still having ongoing restitution to pay, Belfort's current net worth is often estimated as negative. However, his significant earning potential from speaking and media deals keeps him financially relevant, even though he's under a cloud of debt. Belfort's story remains a powerful cautionary tale, a stark reminder of unchecked ambition, the seductive power of wealth, and the destructive consequences of financial fraud on a grand, often deeply personal, scale. His narrative keeps shaping how we perceive Wall Street, really highlighting that constant tension between innovation, the relentless pursuit of profit, and ethical conduct within the ever-changing global financial industry.